What really caused the mortgage crisis? This is a very, very popular question, very popular debate, and I have a feeling that Americans are going to be talking about this and debating this for many, many years. And you can watch movies, you can listen to podcasts, you can listen to politicians, and you're going to hear 100 different theories about why this happened and how complex it was and how difficult it is to understand. It just isn't so. It is very, very simple. A mortgage is the amount of money you borrow from a bank in order to purchase a home. When you go to the bank, what you do is you give them a bunch of financial information, and the bank determines from that information how much money you can afford to pay back over a course of what is typically 20 to 30 years. That process is called underwriting. Underwriting is the assessment of risk. So if you go in to buy a home and you put down 10%, you're going to pay a higher interest rate than if you put down 20%. Why? Because if you only put down 10%, the bank has more of its money at risk than if you put down 10%. This was a very valuable service that banks provided to consumers, in that they could predetermine what was a safe level of debt for the individual to assume. Banks have been operating successfully for thousands of years. Underwriting is their life's blood. Their only ability to survive is based on their ability to accurately predict who will be able to pay them back. If they loan money to people who can't afford to pay them back, the bank's going out of business. So, what's the only thing that could cause banks to abandon something that has been perfected for thousands of years? If you think the answer is government, you'd be correct. Back in the 1980s, the government decided that everybody in America who wanted to own a home should be allowed to own a home based on the concept of fairness. Well, what they did is they passed regulations and rules and laws that undermined a bank's ability to underwrite risk. So consequently, they were being forced to lend money to people who simply couldn't afford to pay it back. The mechanism for this was called the ARM, which stands for adjustable rate mortgage. The theory at the time was, we're going to have an adjustable rate on your mortgage, and if interest rates go up, we're simply going to refinance for a lower amount, because clearly real estate always goes up in value and never goes down. Very, very, very dangerous theory. Well, of course, interest rates went up, real estate market went down, and suddenly we had literally millions of people who had mortgages they couldn't afford to pay back. We got introduced to all kinds of terms like predatory lending and, it's the mortgage broker's fault and it's the bank's fault. Why would the banks commit suicide by lending to people who they knew couldn't afford to pay them back? It's because they were forced to. At the end of the day, the answer is the government changed the rules. They would not allow the banks to exert and use their expertise in underwriting risk to give responsible mortgages, and the outcome was completely predictable. And it really is just that simple. If you're interested in learning more, have a look at our other videos, and if you like what you see, please help us grow by subscribing and leaving us a like on the video.